Welcome to another episode of the Einstein Retirement Daily, where we curate financial, economic, and market news for the headlines that affect today's retiree. Today's headline: should you start investing by putting everything in all at once or dollar cost averaging over time? More on this coming right up. As always, if you hear something in today's podcast that causes you to want to make some changes, take some action, do something with your personal finances, while we're honored that we might be giving you some good ideas, we must insist that you confer with the appropriate tax, legal, or investment professional who knows your specific situation prior to making any changes. This podcast should not be construed as specific tax, legal, or investment advice. Okay, I saw an interesting article today from CNBC. Sarah O'Brien is one of their personal finance writers over there, and she wrote an article entitled, "Here's Why Lump Sum Investing is a Better Option Than Dollar Cost Averaging." And I thought to myself, wait a second. That's very surprising. Let me think about this for a minute. Can I envision how this would be true? No, I can't envision how this would be true. Well, it depends. How often are they putting dollars in and for how long? Yeah, that's the question. Okay, so a very common retirement question that I hear from folks, you notice this is entitled one of the common retirement questions. One of those common questions is, how should I invest some extra cash that I have? So sometimes people will have in retirement a certain set cash flow that they have coming in. Social Security, pension dollars, other forms of income, whether that's withdrawals out of a 401k plan. And sometimes maybe your spending isn't quite what you were expecting it to be, and so you have excess cash or extra cash. If you're in that situation, you may be inclined to say, well, I don't necessarily need these dollars. Why don't I reinvest them? Make sure that I can take care of some expense later in life or something like that. Well, should something like that come to mind and you think maybe this is something I want to do, then what we should talk about here is what are the possible ramifications in a situation where you have excess cash and you're thinking about reinvesting. What's the proper way to do that? Now, one of the things that was a little misleading about this headline is the idea that investing a lump sum amount of cash performed better than dollar cost averaging. So the key points on the article said that if we take a 10-year return on $1 million invested, 10-year rolling years from 1950 looking forward, and you took $1 million, threw it all in one shot, or you dollar cost averaged, you were better off putting the $1 million in one shot 75% of the time. Okay, well, that makes sense because the market's up most of the time. So the only way you really lose on that deal is if the market, you put the money in and the market takes a big hit right out of the gate. So that would be the way that's not going to work out so well versus, say, dollar cost averaging. However, it still didn't quite add up to me, other than the obvious fact that 10 years is long enough that you're probably going to do better if you can put all the money in all at once, okay? That's not really rocket science. So if you have just excess cash sitting around, that's one thing. But most people who think about dollar cost averaging are doing it from income. It's not like you have 500 grand sitting in your bank account that you're going to go invest. You have, say, a part of your paycheck that equates to $500,000 saved over a 10, 15, 20-year, 30-year time period. That's a very big difference. But let's say you do have a pile of dollars, some extra cash sitting around. What should you do? Should you put it all in at once or should you spread it out over time? Well, part of it depends on your risk tolerance, but what this article is citing is a report from Northwestern Mutual that was looking at what if you put all the money in all at once versus dollar cost averaging. The dollar cost averaging period that they selected was splitting the $1 million out over an equal period of payments over 12 months. Typically, with some exception, within a 12-month period, you don't have big enough swings up and down in the market that dollar cost averaging is going to work better for you, generally. Not always, but generally. Also, it is very common for the early part of a year, a first quarter of the year, to be very optimistic in the business cycle and to see pretty nice returns in Q1 of the year. And so if you invest in January and you get great results out of Q1 and then quarter 2 and 3 aren't so good, then yeah, obviously it's going to do better if you just put all the money in quarter 1. A year like this year in 2021 is a great example of that, where I like how I had to look at my calendar to see 2021 is a great example of that, okay? So if you put in a big lump sum of dollars in the beginning of this year versus trying to dollar cost average over the 12-month cycle on this year, you are definitely, maybe I should say, maybe definitely is too strong of a word, but you're probably going to do much better on a strategy like that. So yes, of course, if you're dollar cost averaging over a 12-month time period, there's not enough volatility within a year, typically, for dollar cost averaging to provide you a lot of benefits. The caveat years, of course, are going to be years like 2008, the time period around the dot-com bubble would obviously be an exception. There are exceptions, and they occur about 25% of the time. 75% of the time, the volatility in the markets intra-year are not enough that you get a great benefit by dollar cost averaging over a course of a year. Now the difference is if you dollar cost average over a longer period of time, that's where you start to see the bigger differences, because swings between years can make a bigger difference. But digging a little bit deeper into this, you can see that most of the time dollar cost averaging does not benefit you. So if you want to invest some excess cash that you have, so you have some extra dollars sitting in cash, sitting in savings, not doing anything for you, and you're on the fence, well, should I get those dollars invested or not? If you just want to put your odds with history, okay, past performance is not a predictor of future, okay, we understand that, of course, but if you want to put your odds with history, then you, of course, would want to go ahead and get those dollars all invested, all in one shot. Doing any kind of spreading out of your investment time horizon might give you a risk management component, but it isn't necessarily giving you better odds at getting more return on your money. Now, the other critical component to this is that they looked at a 10-year time horizon. If for some reason you could see yourself anticipating needing these dollars sooner than 10 years, that could very drastically change the outcome of this report. Now, I don't work for Northwestern Mutual. I wasn't part of this study. I don't know what it would look like if we were to shorten the time horizon, but my anticipation would be that if you shorten the time horizon shorter than 10 years, then the likelihood or the probability that there are higher rates where dollar cost averaging was a better idea, my guess is that's going to happen. Because a shorter time horizon means that if bad things happen early on, so you invest the dollars and there's a downturn in the market or a stock market correction, the probability that that has some kind of longer lasting impact or negative impact on you is pretty high, okay? And by long lasting, I mean not so long lasting that you eventually overcome it over a 10-year time period, but long lasting within that 3, 4, 5-year window. So the 10-year time horizon is very important to this decision as well. If you have a shorter time horizon, then you're going to get some additional risk management by dollar cost averaging, say over a 1-year or a 2-year, even a 2-year time period, if you happen to need the dollars, say as soon as 5 years out. Okay, that's all we have for today. I hope you found today's topic to be helpful and insightful. If you have not attended one of our live workshops, we would encourage you to register for one of those events. If you're watching on Facebook, pretty easy, just send us a message and ask when our next workshop is and we can get you signed up. If you're watching on YouTube, you'll want to visit EinsteinRetirementWorkshops.com or find us on Facebook, send us a message, and we'll be happy to get you signed up for a future event. With that, we'll wrap up for today, and I look forward to seeing you next time.